So let's get to the first one right away here. This is Chartwell Retirement Residences. Why did you choose this one?
Yeah, we've got a strong franchise at Middlefield, both real estate ETFs and mutual funds. So we've been in the REIT space for over 20 years. And when we looked at earnings estimates going into 24 and cash flow estimates, Chartwell actually screened as having one of the highest growth rates expected earnings. And so typically stock prices will follow if you're growing at a rapid pace. The reason for that is they're starting to see occupancy trends increase. So a lot of people came out of retirement homes during COVID and now are feeling a lot more comfortable to go back. So if they can get occupancy back to where it was pre-COVID in that 85 to 90% range, all of that extra revenue basically falls to the bottom line and helps their margins. So, we think where it's trading at a 80% or like a 20% discount to NAV is too punitive, and we think it's probably a $12 to $12.50 stock, $12 sometime in 2024. So I really like the entry point here.
Okay, this next name you'd kind of alluded to when we were talking about access and at least exposure to the Asian markets. This is Medtronic, and why did you choose this one?
Yeah, we really like medtech. So in healthcare, in our healthcare funds, we often have a barbell strategy between pharma companies and then medtech, and we're really excited about medtech because again, surgeries, all of that was shelved during COVID. They're starting to come back, and you can see the share prices, all dropped 20, 30% during COVID. So things are stabilizing. They do insulin pumps. They've got robotic technology for surgeries and pacemakers for your heart. So, we think the low is in on Medtronic, and it does sell a lot into Asia. So there's a way to get some exposure there. It's trades 16 or 17 times earnings forward, and it should trade at 20 times. So I think there's 25% upside in this name over the next 12 months.
And I suppose both of these last names, Medtronic as well as Chartwell, are also getting a lift from the aging population as well.
Yeah, that's just a natural demographic tailwind that will help both companies over the next 5 to 10 years for sure.
Okay, let's get to your last top pick, and this is the one that you promoted when we were talking about Pembina pipelines, but Enbridge would be your top pick here.
Yeah, I just looking at their history of growing their dividend every single year, so expect another dividend bump. I think they usually bump it in January or February, but it's yielding over 7%. And look at that chart is just basically what interest rates have done to the stock. And I think once we see interest rate cuts, we'll get a few, in our opinion, next year by the Bank of Canada and a few more in 25. The stock will be back to $52. So, if you can lock in a 7 yield and 8 to 10% upside in the stock over the next year, that's a pretty good total return. So I think it's a really low risk way of playing in energy infrastructure. And again, because we like dividends so much, a 7% dividend yield that's tax efficient for Canadian investors is quite attractive.
Just even thinking about pipelines and the difficulty in getting new infrastructure into the ground, as we've seen even with the Trans Mountain expansion, why would you choose Enbridge, say, over Pembina or TC Energy and all the other players that are in this space?
I really like Enbridge's thematic on the energy evolution or transition. So they've got technology in carbon capture, they're involved in LNG, they're involved in hydrogen. Like, they'll be able to move carbon and hydrogen through their similar pipes that they have in the ground now, over the next 20 years. So, they're going to be part of that energy transition. I really like that thematic as like an added growth area on top of their base business.